Oh yeah. What? You found me on the. I was on LinkedIn. This lady Debbie who runs the mentoring program posted like a their group photo of every that went to the dinner, and you just see actually standing there like his lame face. And I screenshot it and we zoomed in on him and was like, damn, you see this guy pull, you see this guy pull up, what you do. I smiled for every picture I swear. You must have picked up the one that I was not smiling. Cause I was just like this. Look. No suit today either. Right? Rush down like every day's been showing up with a suit tie. Not like
Hi, Ricky. We're going to give it another minute or two. I hope you're doing well. You probably see that you're muted, and we've got a few people here, but we're going to, I think we had around 10 registrants, but one of them is like the 4 or 5 people that are in this room. So just going to give it another minute. I hope you're doing well.
Good to see you.
I was already done.
Yeah, right.
There's no. I think we can.
It's being recorded.
Yeah.
Can you call it on actually?
Yeah, but I think it's like Yanderano.
It is.
Yeah,
But
last day.
you can get on.
Yeah. Say, what is it, Ramadan Adib? I don't know. Is she over on? She's over. No, Ramadan Adib is pretty talented. Oh, I thought you said Nadeem. She's like, yeah. Oh, Nadeem, I know. Hello? Are you hot? Are you hot? Gotcha. Okay. Sounds good. All right. There you go. All right, bye.
All right.
Yeah. All right. I'm ready. No, you're good. I don't know. He's on the highway.
All right. I'm just going to kick it off. I hope that's all right. Ricky, I'll turn the camera around so there's a few people here and you'll be able to see them. But I'll just get things started. So welcome everyone. I guess this is a student investment club meeting, so we'll keep it in that category. Let's see. Welcome. It's Thursday. It's the new Friday, pretty much. In business news today, I would say, what's up? India just passed China on population size. That's interesting. I also saw another thing, but I forgot it. Oh, I saw there's a study, I guess, in one of the podcasts I heard, they said if a house has a she shed in it, if it says that in the description, it sells for about 2.5% higher. So if you had a house, make a she shed and market it that way. Yeah, so on average, it's about $17,000 more you can charge for a house. Gone are the days of the man cave selling for higher. Now it's the she shed. And I've heard that if you have a house by the ocean with the she shed, then it's she shed by the seashore. So there you go. All right, I was able to do it. All right, so kicking it off, we've got Ricky Heichman on the Zoom call, and she's got an incredible resume. I'll also introduce her this way. She is my sister-in-law, so I know her personally from being in the family. Ricky is very esteemed in the career world. She had an internship, I believe, at Bridgewater, which is the #1 hedge funds, essentially. She was also an intern at Jane Street and then got a full-time offer from Jane Street and became a quant trader from there. She'll go into it a lot more, I'm sure, or as much as And I also know Ricky as an esteemed costume designer, so she probably won't talk about that so much, but let's get into it. So Ricky, you can go ahead and unmute yourself, and hopefully we'll be able to get everyone here. It is being recorded. There's a few people who aren't here who really told me that they wanted to be here, but I'll convey all that information to them. So Ricky, thank you so much.
Thank you, Burton. Yeah, no, actually, an esteemed resume that opens with the line Burton's sister-in-law. So lucky to have that accolade as well as the others, and very happy to be here talking to you guys. Burton, can you confirm that everyone can hear me fine?
Yeah.
A thumbs up. Okay, great. Fantastic. Hi, everybody. Lovely to meet you. Excited to be here. So what I'm going to do is I'm just going to talk for a few minutes, maybe like 5 minutes tops, about my career trajectory of how I ended up at Jane Street and what job it was that I was working there, why I made that decision, and what my time there was like. And after that, I'm basically going to open it up to Q&A. I have kind of some questions that I get more often than others. So if the audience doesn't have too many questions, I'm happy to just answer from some of those. But if you guys do have questions, I'm here and basically happy to answer whatever. And Burton, how much time should I expect this to go on for?
It's up to you. If you have 30 minutes, we'll take 30 minutes. If you have 40 minutes, we'll do 40 minutes. But really, it's up to you.
Awesome. Sounds great. That sounds perfect.
If there really are no questions, I'll also help wrap it up.
Cool, great. Okay, I only have 6 hours, so we're gonna have to keep the questions tight. Okay. As you can tell, the life of a quant trader is very busy. Anyway, so lovely to meet you all. So I'm Ricky Heiklin. I studied computer science as an undergrad, and I originally had no intention of going into finance. I haven't taken a single class in financial engineering or economics or anything along those lines. But when I was in undergrad, there were kind of applications at the career fair for a few different jobs. The financial industry promotes itself quite well at the career fair, and I had a few friends who'd gone into different things, so I figured I might as well interview. Like Burton mentioned, I interned at Bridgewater, a hedge fund with a very interesting culture of a lot of what they call radical transparency and like aggressively open communication and feedback the summer between my sophomore and junior years in college. And that was a pretty interesting experience that I'm happy to go into more. I'm going to focus mainly on Jane Street, which is where I worked for a few years, but happy to also talk about Bridgewater if people are interested in that. Then the summer between my junior and senior years, I applied to work at Jane Street, and I didn't originally think that I would get an internship there. In fact, the program that I applied to was a like winter program for women that was like still kind of like emerging women who are learning more about math, but the application for it seemed a lot of fun. It was this kind of like complicated puzzle competition, and I loved these kinds of like game theory problem solving situations. So you had to submit a set of soldiers to compete in different castles against other people's submissions of soldiers spread across those castles. And one thing that Burton knows quite well about me is that I love strategy games, and I love kind of like figuring out what is the optimal approach based on what other people are going to do, etc. So I really enjoyed that and figured, okay, if I'm playing a game like that, if that's the kind of thing that this place is interviewing based off of, I might enjoy that. And then they invited me for an interview for their summer internship. I ended up interning that summer. They gave me an offer for a full-time role as a quantitative trader, and I accepted that offer and ended up being a trader at Jane Street for about 2.5 years. So I joined there in August 2019 after graduating college, and I stayed until January 2022, about a year and a couple months ago. Okay. So to share a little bit about kind of what that was like, what my work there was. So my role was quantitative trader, which is a phrase that means a slightly different thing at any of a number of different places. So sorry about that. But specifically what it meant at Jane Street was that I split my time evenly between 3 different things. One was coming up with ideas for trading strategies. And this is what we would call something like research, where I would kind of think of like, okay, what happens if we buy stocks that start with the letter A on Monday and sell them on Tuesday? Is that a strategy that is going to do well? Now, that specific idea is, pulled out of a hat that has no specific logic behind it. Usually we would come up with ideas that would be rooted a little more in some idea about either, macroeconomic concepts about companies or microstructural ideas about exchanges. But let's say buy stocks that start with A on a Monday, sell them on a Tuesday. Have an idea like that, and we'd want to research it. So we would look at kind of like tons of data about how stocks have performed in the past and do a lot of analysis, often using, let's say, like Python, using a Jupyter notebook, and running various simulations of like, let's say we had done this strategy historically, how would things have looked? But you can't just look and see how those stocks have performed, because you also need to think about, let's say we had bought and then sold those stocks, those actions would have also had an impact on the market. How much would that impact have been, and how much would that have cut into how much our profits are? How much are we failing to account for, let's say, survivorship bias in terms of which stocks we're looking at, whereas which of those stocks might have gone out of business, etc. So there's a whole bunch of adjustments we want to make. Let's say we've seen this strategy work well in the past, but has there been some kind of regime change or law change or something like that that means that it doesn't go well anymore? Have other people noticed this strategy too and started to profit off of it? And because of that, the trade has like mostly gone away because other people are already eating up the full share of money that can be made there, etc. So that will often be the kind of like research phase of deciding, is it a good idea to trade this strategy? And if so, kind of like, what size, like under what conditions, like how do we know if it's still good after a certain amount of time? How confident are we that it's good? How good do we expect it to be, in the sense of how valuable do we want to, like, how many resources do we want to focus on that relative to other strategies, etc. So answering a lot of questions of that variety. That's the research phase. The second thing that I would be doing would be the kind of trading phase. And that would be literally actively and manually trading those strategies, saying, okay, it is now Monday morning. Today on Monday, I am going to go and like insert bids into the opening auction at the beginning of the day to buy this amount of Apple shares, because Apple is a stock that starts with the letter A. And then on Tuesday at the close, I'm going to insert some offers to sell some Apple shares in order to close out of my position. And I'm going to monitor for what's going on in the world. So for example, did Apple just announce news of like, new weird changes that they're making, or do they have kind of dividends that they're paying out today, or something else that would cause their stock to move weirdly such that I shouldn't do this kind of trade for any reason? Or is there some reason to think it would be adverse for me to engage in the market like this? Okay. So that will be kind of like one consideration, but that would be me kind of manually trading. And the third thing that I might do, which falls more under the bracket of development, of like software development, would be to actually take those trading strategies and algorithmically record them so that the computers can be doing most of the work themselves. So this would be basically like, and this code at Jane Street we wrote primarily in OCaml, which is a functional programming language that nobody else in the world uses approximately. So thanks Jane Street for teaching me all those skills. But I would kind of like take that code and write it up into our proprietary trading systems in OCaml so that the trading could happen automatically. You'd think that we would want to just skip from step A to step C of like research to development, because why is it that we should ever be doing that trading manually? Like, why should a human be involved in it? And in fact, almost all of our trading strategies do get written up algorithmically, but there's still a lot of work for a trader to be doing in terms of watching the markets and noticing, when do the usual conditions that make a trade good no longer apply? When things are crazy, when things are weird, when we notice different aberrations, somebody needs to be watching and monitoring our trading systems to see, are we suddenly losing a ton of money somewhere that we might not have expected, in ways that you won't always succeed at programming into your like algorithms. Like, you'll think, okay, we want corner cases of like, if this stock has dropped 90%, maybe we shouldn't trade it. But you might not think, okay, if it has done this weird thing where it like had like a sudden blip downward and then a blip upward and movements like that, but right now it's back to its usual price, like your algorithm might not account for that. So you're going to want to figure out how, like, what kind of trading instincts a human should develop that will help you catch more cases than what you're going to remember to successfully program into your algorithm. Likewise, when you're writing a lot of code for a lot of different strategies, there's going to be some bugs in it. You want to have human eyes on what the code is doing, so that you can catch bugs like those, and if need be, press the red button and put everything on pause. Okay, so those were 3 of the kind of main components of my job at Jane Street. Finally, I want to answer a question I often get about my choice to leave Jane Street and the job I took briefly following that. Just to say the following, when I left Jane Street, it was because my manager at Jane Street was also leaving Jane Street in order to start a fund of her own. Specifically, she was starting a crypto hedge fund in the Bahamas that was going to focus on statistical arbitrage trading strategies. And it was funded through FTX, which is a former crypto exchange, because she knew quite well Sam Bankman-Fried, the person who'd ran that exchange. There were a lot of things that were kind of weird about this company's setup. So in the end, what I did was I left Jane Street. I worked with this former manager of mine on this new hedge fund for about 2 weeks. And I had a lot of questions for them about the auditor process and legal questions and other various regulatory things like that. And it ended up being that they were not too happy with my questions and decided to let me go after a couple of weeks. So my departure from finance happened pretty quickly, but I did have a couple weeks there where kind of locally I'd left Jane Street, joined this crypto hedge fund in the Bahamas, and working for them, but then got fired from that after a few weeks for asking too many questions, or, plausibly for other reasons that I don't have access to. And then since then have basically been doing nothing directly in quant trading, but instead have been exploring a lot of other jobs. I spent this past summer teaching quant trading concepts to high schoolers. So I have a lot of thoughts on like pedagogy and education around that. But that kind of rounds out my story. And now that I've used far more than the 5 minutes that I told you I would keep this to, I am more than happy to take any questions you might have.
Yeah.
Hello, my name is Yeshua. I was wondering what kind of like questions do they ask you when you're interviewing? Like what kind of like terminology do you need to go with, or what kind of knowledge do you need to have?
Yeah, great question. So I'll answer this question for Jane Street and for Bridgewater, and the answers to those two are going to be pretty unhelpful because they do not generalize to other companies, because I think each of them have pretty unique interview styles. So I'll start with Bridgewater because that's the one that I did first. Bridgewater's application style is basically assume that the person knows nothing whatsoever about finance. We don't want to take people with an economic background. We want to take people who are smart and we can teach them about economics in-house ourselves. And they'll have you show up to the interview with a couple ideas of questions that you have, and then they'll do a group interview where everyone shares their questions. So my question was, can you establish a argument for why humans have rights that includes all humans and no animals? So a case for human rights, but not animal rights, that captures all humans and no animals. And they ended up choosing that question, and we had a group interview, me and a group of like 8 other people applying, in which we discussed that question for about half an hour. So that was the application process for Bridgewater. Again, not the kind of thing you're going to see at most financial institutions. At Jane Street, the process looked a little different. In the interviews, each interview was almost entirely like math and logic puzzle questions. So these would be questions where they would ask kind of questions in the realms of probability, logic, problem solving, where they would ask a question and you would not just like sit there using pencil and paper and then produce the answer, but talk through the answer with them. So you would talk through your thought process and like, okay, why is it that you got to the answer you did? Often these questions would have multiple parts, or the idea would be like, you would produce an answer, but there might be something wrong with the answer, or there might be something you didn't consider. So they would say, okay, like, let's say, like, have you thought about X, or what assumptions are you making, or conditional on your answer being wrong, where do you think you went wrong? What is it that you could have done better? I think that there are actually a number of Jane Street interview questions that have been posted online. I don't know which ones are like kind of posted by Jane Street itself versus on Glassdoor or other websites along those lines. But I'm looking to see right now whether they have kind of any examples there. So yeah, they do have some kind of like mock interviews that they have on their website that show kind of what those things would look like, but also on Glassdoor you'll see a lot of like interview questions that people have posted in the past. So I'm clicking through to it right now. And seeing if there are any that feel like good examples to me. One moment, I apologize. Okay, I'm not seeing right now any that like stand out as especially good ones. But a lot of them will be about kind of the expected value of a few die rolls, or of a game that involved kind of like a lottery component, some kind of randomization process, etc. Often it'll be kind of like trading games in which you are competing with another person or something along those lines.
Ricky, I've heard some pretty crazy stories about what it's like in Bridgewater, and especially with Dalio. If you're okay talking about some of your experience there, that would be great.
Totally. So I'm very happy to share. I will caveat that I was only there for a couple summers, and I was only there as an intern. So there were a lot of restrictions on how much information I had access to, both in terms of IP sensitivity, and also in terms intellectual property sensitivity of not being shared with me on various like documents and information, and also in terms of just how much I actually got like acculturated to the workplace environment there. That being said, here are a few things about Bridgewater that were pretty interesting. So one element is that they record everything. So every meeting they have, interactions, like, etc., they'll record. And the thought process there is like, everything that you're saying, like, you should feel comfortable saying to everyone. And the intention of that is not to silence things, but to kind of like have more accountability and more like, instead of he said, she said, or like what happens behind closed doors, or like who knows kind of what the implicature is, you can actually look at a situation head on and understand like what was it that happened there, and like can we like memory can be enormously fallible, and instead of allowing our memories and like rewritings of history to determine how things took place, instead being able to root that in like actual facts and be able to go back to the tapes and review it and understand it better. So they record everything. Another thing they did a lot was they had this feedback system called dots, where you would give coworkers dots on a variety of attributes. So let's say the attribute of like timeliness, how well someone shows up to a meeting. If they show up on time to meetings all the time, you might give them a 10 and say like, this person's doing an excellent job at that. If they show up late to a meeting, you might say, okay, I'm going to give them like a 4 dot, like they were a few minutes late. It could have been a lot worse, they could have missed it entirely, but they were late to this meeting, so their timeliness is not doing great. Or let's say the attribute is like creativity. And somebody keeps proposing like really creative solutions to problems that are outside the box, or they ask a lot of good questions. You might give them dots that are high meaning like 10s or 9s or 8s on those attributes. Everybody can see everybody's dots. You can see what dots other people have received. You can see who gave those dots. You can see when in time they happened. You can see any comments that were posted along with those dots. And you can look at somebody's dots and notice kind of changes in time that take place, having to do with people's like, you can look and limit it to certain categories of attributes. You can constrain it in different ways over different points in time and do some like analysis on that information yourself. And this can be a convenient way of looking at, look, if we think that this person is a really creative thinker and asks a lot of really good questions, but they're terrible at like finishing projects or following through on things. Maybe we want to make it the case that we're pairing them with someone else who has way better execution skills, even if that person has lower creativity. That the idea is like, if somebody has a weakness, there are several different ways of dealing with it. You can try to get them to improve that. You can have them do jobs that don't require that strength. You can have them work together with somebody else who does have that strength so that they don't need to have it. You can, fire them and say somebody without a strong enough trait like this is just not going to make the cut to be a good enough employee here. There's various different approaches you can take. And that a better understanding of everyone's relative strengths and weaknesses is going to be better on the whole, in that it's going to allow you to understand like how to deal with those things. Of course, as you might imagine, there are also ways in which an environment that is constantly surveilling you and ranking you, and for which one of the possible outcomes is you getting fired, can be an extremely stressful environment for a lot of people. I didn't experience it stressfully. I actually really enjoyed it. But part of why I was able to not experience it stressfully was because during the summer internship, I was there doing well. And I think that if I'd been doing poorly, it would have been an enormously different psychological experience for me. And part of why I chose to go to Jane Street and not Bridgewater is because I was pretty nervous about what that environment would be like for me if it weren't in the context of a summer internship, but instead a full-time job. And if there were points where I was struggling much more so with the quality of my work and how I was performing there. That said, I did really enjoy it, and I thought it was a really interesting place to be, and I thought it was a really interesting kind of like psychological experiment to drop into for the period of a few months, and I'm enormously grateful that I had that opportunity and took it.
Within the context of what you were saying with the 3 areas that you focused in at Jane Street, can you maybe provide some rough example of one trade that went really well, that you really nailed, and what you learned from that, and then of course one vice versa that you missed and why, what you learned from it?
Sure. So unfortunately, I can't speak to specific trades we did in the market, because all of those are kind of protected information. But I'm happy to talk about kind of like genres in which I would make mistakes, types of mistakes that I would make, or types of successes I would have that I feel more proud of, and that feel like they might be representative of some of the stuff that we did. So without speaking to the specifics of the trade, it's very easy for me to recall many instances of mistakes that I made, or times that it's clear that I should have done something better. And a lot of these actually come down to being, what we call fat fingers, where you like mean to type one thing and you end up typing the other. You can have a brilliant strategy, you can have a great idea, you can be the first one to the mark, and if you type sell instead of buy, let me tell you, that is not going to look good for you. A trade that is good to do, you might get to do, or somebody else might have done it first. A trade that is bad to do, you are definitely going to get to do, because somebody is going to be happy to take the good side. This is a concept called adverse selection, where there's this asymmetry between the circumstances that look good and the circumstances that look bad. And what that means is if you make a typo for a good trade and it goes in the bad direction, you're definitely going to do that bad outcome. Whereas let's say you have a bad trade and you typo in the good direction, it still might not end up being that good thing, because it's possible you won't get to do that trade because someone else will have gotten there first. And there are so many times where I've typoed where, I sold instead of buying, or even worse, I swapped the price that I wanted to trade at and the size that I wanted to trade. So if I want to trade, for a price of 100, one share of a stock, but instead I go and I want to sell for a price of 100, but then instead I sell for a price of 100 shares of that stock, that is such an easy mistake to make. It just means typing a couple numbers backward with devastating consequences. You could imagine that when you are trading, 100,000 shares of something for some like small price, and you get those things backwards, but not, zero price, not negligible price, and you get that thing backwards, that could have a lot of really costly outcomes. And in fact, there are stories of traders, not at Jane Street, but at other places, who have lost their job based on one single typo like that. So yeah, pretty easy for me to bring to mind mistakes that I've made along those lines. And look, if you don't do any trading, you don't make any such mistakes. So it's going to be the case that the fact that I make mistakes means that I was actively engaged in trading. But these things are common and lots of people do them, but obviously you want to reduce how much you're making mistakes like that. In terms of trades that I did well, I think that the trades that looked best are, oddly enough, not the trades that like looked 90% likely to be good trades, because those trades often ended up actually being like way less available because everyone else also knew they were good trades and they were doing those trades too. Or often there was someone else at Jane Street already doing those trades who I just didn't like realize was doing those trades because they sat on a different desk from me, or they had other kind of like ways in which they'd formulated or thought of that trade, but it was still effectively the same type of trade. The trades that are the best ones are the ones that look like 55% to be good. And those trades are way less likely to be done by other people in the market already. They're less likely to already be covered. And therefore there's more kind of profitability there because there's more reason that like Jane Street has a like kind of unique reason to be the person doing that trade. Like lots of people at home sitting in their houses who like think like, oh, this trade is, you know, good to do, who are going to do a trade like that, that makes sense. But for a 55% to be good trade, there's going to be fewer institutions that want to take on that risk. And because of that, Jane Street is more likely to be well positioned to absorb that risk and do that trade and have it be profitable.
Ricky, you talked about Jane Street being like a liquidity fund before. Can you tell us a little bit about that?
Yeah, so Jane Street, one of the things that we did was we were liquidity providers. And what that means in this context, so liquidity is kind of like how much trading is available or how easy it is to trade a certain stock or financial security. And we were liquidity providers in the sense that like one of these services that we were creating for the market, and that Jane Street still is, I'm just not there anymore, is making it possible for people who want to trade a certain security to do so at reasonable prices. So if nobody ever wants to trade some weird Argentinian bond that is like relatively illiquid, like they're going to, if they go to the market to try to trade, even if the true value of this thing is around 100, people will only be willing to like buy it for like 80 or sell it for like 120. They're going to have this pretty big markup because they don't know who they're trading with or whether that person has more information, etc. if this thing isn't traded that much. Jane Street will come in and say, we will assume some of that risk. We will buy this thing for 99 and sell it for 101. Now, what's our profit? Our profit is that if people are coming in every day and they're willing to like, you know, they want to buy this bond, they'll buy it for 101, and someone else comes in at a different hour, they want to sell it, they'll sell it for 99. Jane Street is profiting the like difference of two between those. And if Jane Street continues making that market, great. What's the downside? The downside is if somebody knows that the true value is 120, and like, you know, they might not have, or let's say they know the true value is 118, they might not have traded with the like person who would have sold for 120 before, but they'll happily trade with Jane Street selling for 101. Well, the person who knows the true value is 118, if it actually ends up being 118, they're going to buy the 101. They're going to buy it again and again and again and again. And Jane Street will eventually go, this is suspicious. So we might move our offer back to 102 or 103, but they're still going to keep buying it. Jane Street could go out of business if they keep reloading that offer and somebody else has secret information. So figuring out how to manage that risk is definitely a tight balance, but Jane Street is providing liquidity and that we are making it possible for other people to trade in a market that otherwise they wouldn't get nearly as good prices, and therefore wouldn't do as much trading in. So we're increasing the trading volume that happens there by being the ones to provide a bid and offer, to provide those 99 and 101 quotes. Are there any questions about that? I'm not sure I explained that so straightforwardly.
Yeah, so you're saying like you're making markets, right? But like, yeah, so like how quickly I got how quickly were you guys like deciding, okay, let's make this market or not? And like then how quickly would you have realized like, oh, okay, the true value is something completely different and we don't have that information? Like, how quickly does that all happen?
I would say that there are lots of different time frames on which these kinds of decisions happen, but the two main ones are algorithmic, like, you know, microsecond, like, or faster decisions of we have programmed into the proprietary trading systems that we have all sorts of like conditional statements that are like, if you see this kind of microstructural behavior, if these kinds of orders come into the market, you want to shut down your trades, or you want to do these trades in the opposite direction, or you want to adjust. Let's say somebody comes in and they buy this like bond for like 101 and then they buy it for 102, 103. Our algorithm might say either, you know, back off of your offer by a whole bunch and now only start offering it for 120, or offer it for smaller size, or make an alert noise that will tell the people on the trading floor, hey, guess what? There is this trade happening that like there's this like trade happening in this market that is uncommon or unexpected, or that you might want to like react to in a certain way, and that will like alert a trader. So the kind of first level on which like time frame on which these adjustments will get made is like nearly instantaneous, and speed matters a tremendous amount here, because however fast we are, our competitors are also really fast. We're like racing against the same like latency constraints, and we spend a lot of time actually thinking about kind of like on a programmatic level, and like in terms of our location relative to where different exchanges are, and like what kinds of like cables and fibers we use, like how fast is our response time. But then the second level is the human level. Like I said, one thing you might program in is alert the humans if things are going weirdly, and then that will require a human seeing it and thinking about it and reacting to it. And one thing that Jane Street culture is huge on is press the red button. If you see anything that's kind of weird, you don't have a story for like why it's weird, like you don't have a kind of like immediate obvious action move. And especially if it's weird like across markets, or you see multiple weird things going on at once, press the red button. This will shut off all of the trading, either whether that's constraint to that strategy or that desk or the entire firm or whatever. But that even though it's extremely costly for us to be off even for a few minutes, it's better than putting ourselves in a situation where a single bug in the code causes the firm to go kaput.
I have a question. Where do you guys source your data from?
Yeah, great question. So Jane Street has a lot of different data providers. And one of the reasons for that is we trade all sorts of different financial products across all sorts of different markets. So we're not just US equities. I was on the US equities desk, but we also trade international equities in a number of different places. We trade crypto, we trade bonds, we trade, exchange traded funds and international exchange traded funds and commodities and various other things like that. So where we source our market data from is often going to be a question that like is on a desk by desk basis. So the US equities desk will try to get the best sources of US equities market data, but other people will be sourcing data from different providers based on what the best in class in their industry is. And one thing that's really important to Jane Street, like I mentioned, is speed. And because of that, we want like tick by tick market data. It's not good enough for us to have snapshots of prices every second or every 5 minutes or something like that, including for historical prices. Like when we're running a study on like how would this trade have done historically, if the trade is buy stocks that start with the letter A on Monday and sell them on Tuesday, maybe it's okay for us to just have screenshots, like snapshots of prices every 5 minutes for our historical market data for a trade like that. But lots and lots of our trades will look a lot more microstructural, a lot more granular, have a lot more to do with like literally every tick, every action item that happens in the market, like what happens immediately before and after it, what does the market look like in those intervening moments, etc., how much time passes, and we'll need to have very granular data there. For like IP intellectual property reasons, I can't reveal specifics of any of like Jane Street's choices in terms of data providers, but it is I think kind of like reasonable to say that Jane Street, the market data for like what it is we receive in real time needs to be like every single piece of information on a really granular basis. And for what we use for historical data, we also want to have pretty robust data, though of course we have way better tick data about, trading in 2022 than we do about trading in like 1980. And there might still be the kind of like macroeconomic like cyclic like trades that we'd be interested in, though we focus a lot less on those. Those are more the domain of hedge funds or like longer term strategies over the course of many years. But we might want to look at something like that.
Thank you.
question, so could you like kind of like walk through like almost like a typical day at Jane Street, and like, did you like work like crazy hours? Like, what was that like?
Sure. So my time at Jane Street started in summer of 2019 and went until winter of 2022. And a big chunk of time in there was the COVID pandemic, which means that what a typical day looked like for a lot of my career is actually pretty abnormal for what it would look like in general for a Jane Street trader over the past couple decades. That being said, in terms of answering your questions around hours, I think Jane Street itself actually had way less crazy hours than a lot of other financial institutions. There were definitely some days that I worked crazy hours, but there were a lot of times where I would get into work typically, if I was starting up systems myself, I would get into work around 7:30. Otherwise, I would get into work by like 8:15, 8:30. And then I would be in work typically until like 6:30 p.m. So this is still definitely much longer hours than like a 9 to 5 job. But compared to some other financial institutions, I know people who work at like the big banks as analysts, etc., will often be working like, I don't know, like 70, 80-hour weeks. And we didn't quite have anything like that. I mean, it depends on the individual. Also, there's a lot of variance in how much people work, but that was my experience, at least. In terms of the like typical day for me. So I was on the US equities desk. I would get to work and the first kind of couple hours of my day would be devoted to the opening auction. So US equities, the markets open for like day trading at 9:30 a.m. and close at 4 p.m. And that means that a lot of the day of a US equities trader are oriented around that opening auction and that closing auction, because there will be a lot of liquidity that happens at those hours. A lot of the ways that people trade will be on those auctions, because they're kind of like Schelling points or communally agreed upon like times that more trading occurs. And as a result, a lot of the hours of my day will be spent thinking about what orders do we want to submit to the opening auction. That's often a function of like what has happened since last night. If there's been like a war that broke out at like 10 p.m. last night, the markets are going to go pretty crazy, and the kinds of orders I'm going to want to submit to the opening auction will be pretty different from usual. If, no war has happened, but like, the tech stocks have shifted this amount, and the like, like, I don't know, like medical, like insurance, like companies have shifted in the opposite direction by this amount, there might just be some tweaks I want to make to my opening auction portfolio strategies that I want to incorporate and trade off of. So that'll be a big chunk of my day. And then the time in the middle will be more devoted to researching new trading strategies and coding those up instead of as much the like manual trading of like day-to-day decision making. That will mainly happen near the open and the close. Though, of course, I also have some amount of that time devoted to, in the background, monitoring the live trading that's happening by our systems just to see if anything's going wrong. That's less often to like find active trading opportunities myself as it is to see like, is there anything broken, which our systems will try to alert us with a lot of different colors and sounds and like flashing lights and stuff. But there's a lot of different ways things can go wrong and a lot of different magnitudes of how wrong that will be. So having an eye on that is pretty important.
So I have a question. Is there any technological skills that are really highly appreciated during this, if you want to like get a job as a quant trader besides like a Python or R Studio?
Sure. So great question. So I will say that the kind of domain, the area for which these like technological skills in particular are most valuable is going to be for a job as a software developer at Jane Street. If you are applying for a job as a quant trader, which is the role that I was in, having expertise or being especially good at certain specific technological things is less important. That being said, it's still really valuable to have a computer science education. And I would say that the thing that I would push you toward the most is Python. Things are kind of, in the past, Jane Street has used OCaml for all of its systems. And that's true for its like algorithmic trading systems, but Python is useful across a lot of different frontiers in terms of making studies, and nobody in any company is going to like hold it against you if your language is Python and not whatever language they locally use, because Python is such a kind of like universally accepted, like reasonable choice for programming. And there's a lot of ways in which getting good at Python will end up being useful for some of the kinds of work that you would do at Jane Street. So I would say you want to improve your skills there, in particular using things like pandas, which is a library for adjusting data frames, a way of like storing information, and a lot of the kinds of like studies that Jane Street might do of historical data would be the kinds that would employ different data structures, whether that's data frames or the contents of tables like SQL tables, SQL, a data base processing language, and you might want to like have those Python skills available to be able to use those. That being said, Jane Street's interview questions for quantitative traders are not going to require any coding whatsoever. They're not going to be, or at least they didn't when I was there. It's possible that things have changed, but you are not being tested on your programming skills. Obviously, if you are a good programmer, that has additional benefits and you will need to do a lot of programming on the job itself. But the thing that they're assessing you on for purposes of would you make a good trader is not how good a programmer you are.
Really cool.
Okay, thank you.
Oh yeah.
Ricky, for someone that was in quant finance, what advice would you give to someone that's in this call or sitting in this room, even if it's cliche?
Yeah, I think that like an important thing in the markets is that at each point, like at each time t, you want to be making your decision at time t+1 based on all the information you have at time t. You don't want to be stuck with whatever decision you like, had thought was the best for you to make at t+1 when the time was like t-1. You want to constantly be reevaluating based on all the data you have, as a like Bayesian updater, as a person who cares about like taking in all of that data to make the best possible decision you can. And I think that this is the kind of principle that a lot of people who are in trading recognize applies to the trading world, but don't necessarily have applied as much on making decisions for their life, making decisions for how they interact with one another, making decisions for what job they want to take or what they want to do. I think it's very easy to be susceptible to the kind of like status quo bias that will result in you making a life choice and then sticking around with it. I think that I stayed at Jane Street a lot longer than I should have. I think that like there are a lot of benefits to working at a quant trading firm, absolutely. And there's a lot of reasons that I'm happy that I spent time at Jane Street, but ultimately it was a way better call for me to leave working there. And I think that like I spent a lot longer there than I ought to have for the purpose of like the trajectory of my life. And it is very easy to fall into those kind of habits. Likewise, I would say that like right now it might seem like the best place for you to work is Bridgewater because it has a certain kind of culture that feels exciting. But if you go and spend a couple weeks there, even like a one-day interview there, and the culture turns out to be different from what you'd assumed and what you'd baked into your like kind of pro cons list and utility function of whether you want to work there, then take that information into account. Don't be like stuck on a decision because you used to think it was the right decision and now, well, it's probably still the right decision because this thing has only changed this amount. No, constantly be kind of reevaluating. Obviously, there are costs to each kind of computational evaluation in terms of how much brain space you have, how much energy it's worth. So you should be using heuristics to decide where do I want to focus my decision making. But by and large, I think that like constantly kind of being willing to apply trading principles in your life decisions as well is one of the things that I've like learned the most from my time at Jane Street, more so than any specific kind of financial piece of knowledge.
Really cool answer. I want to just make sure everyone gets a chance to ask whatever questions that they have. It's not every day that we have Ricky Heiklin or somebody at Ricky's level coming in. So please, anyone online, if you guys have any questions, or anyone else here, go for it, okay? If not, I'll ask a question. How does the backtesting work at a firm like Jane Street?
Sure. So I'll answer that in a couple ways. One is that I'll say that a lot of that kind of stuff will be done, let's say, by people on the technology side. So that won't always be the like case that like for the algorithmic trading strategies themselves. However, what we will do in terms of, like I said, in the research phase, like taking a strategy and seeing kind of like how it would have done historically, we'll be taking the like data that we have available to us, like years of history of market data, and applying that same trading strategy in the past. So we basically want to see what the like viability of that trading strategy is on the historical data available to us. And if the strategy is, buy stocks that start with an A on a Monday, sell them on a Tuesday, we want to look at the data for every Monday and Tuesday, the prices at the open and at the close, for stocks that start with an A. We're going to take the full realm of like stocks that start with an A on every single Monday and Tuesday in the past, and its prices on the opening auction and the closing auction, and see what those dates are like. And then let's say we see, oh, this looks like a good trade. We want to also tweak things about it. Well, is it also a good trade for stocks that start with the letter B? Or is this a thing that is like uniquely constrained to stocks that start with the letter A? Is it only good buying on the opening auction on Monday and selling it on Tuesday? Or what if we did that on the same day? What if we did, Wednesday to Thursday, etc., to figure out? We might have a story for a like hyper specific subset of a broader pattern, but if the broader pattern is like the reason that this thing is happening, maybe stocks just happen to go down over the course of the trading day. They start higher and they end lower, or they start lower and they end higher, or whatever it is. And then like we shouldn't kind of like come up with a story that's about a kind of specific subset that doesn't apply in general. Finally, I mentioned earlier worrying about survivorship bias. If you're looking at how well stocks did based on the universe of stocks that currently exist and not based on the stocks that existed a year ago, you're going to be excluding stocks that have since gone out of business. So let's say there was a stock called Abstabloom that was in business a year ago, but then did really poorly and went out of business. You might not look at Abstabloom because it's not on your list of current stocks that exist, but how it did would have affected how your strategy did a year ago. So if you're ignoring it, then you're going to end up with some data errors that will make your strategy potentially look better than it would have been, because if you'd been holding that stock and it went out of business, you would have lost money there. But if you're looking at your strategy as though you weren't holding that stock because you no longer are thinking about it and have it on your list of stocks, then you're going to think that you did better than you did.
Cool. Yeah, all right. Okay, yeah. Okay. All right, let's close it up. Please, if anyone has any more questions, it's so nice that Ricky was able to join us today. It's really special for Ricky to come to William Patterson. So if you guys have any other questions, please ask them. Otherwise, I think we're gonna start to wrap it up. Do you have anything you want to say at the end, Ricky? I'll also just say like Ricky, yeah, she's my sister-in-law, but like she's also a dear friend, and I personally really appreciate Ricky coming in today. Anything else you want to say? Like any internship advice? A lot of us are still looking for internships.
So I would definitely say apply early and often. I think a lot of the internships, even if you're thinking about internships for this summer, like come next summer, if you'll still be in the internship pipeline, start applying as early as like August or something, because a lot of these places are pretty like cutthroat and open up their processes pretty early. I would also just say like what I said about kind of wanting to evaluate your decision at T+1 at every single time T, like there are times where it will make sense to be pursuing these things, and there will be times where it makes sense not to. And I feel like pretty happy that I got to learn that. It was great talking to you all. One of my favorite things to do is to be teaching about trading. Like I said, I taught high schoolers this past summer about trading concepts, and I enjoyed a ton. So I hope you enjoyed. And I wish you all the best of luck with all of your different financial and investment learning opportunities in your futures.
Awesome. Okay. All right. Bye, everyone.
Bye, thank you.